Ray Dalio has been warning about the coming economic downturn for some time now. He believes that we are at the end of a long-term debt cycle and that this will have significant implications for the global economy. In today's video, we will be discussing Ray Dalio's last warning. So, before going into depth, let's first know who Ray Dalio is. Well, he is a billionaire investor, hedge fund manager, and philanthropist who also is the founder of Bridgewater Associates, one of the world's largest hedge funds. He has been sharing his thoughts on the economy and the financial markets for years, and his predictions have been quite accurate. In his latest warning, he talked about the economic cycle and how it will repeat itself. He believes that we are at a turning point in the economic cycle, and we need to prepare ourselves for what is to come. In this video, we will discuss his warning and what it means for us. Dalio argues that this is not a new phenomenon and that it has happened before. He says that the history of the economy is a series of debt cycles. According to him, each debt cycle is characterized by a period of growth followed by a period of contraction. These cycles can be seen in the rise and fall of empires, and they can also be seen in the history of financial markets. He says we are currently in the late stages of the long-term debt cycle and need to prepare for the coming economic downturn. He warns that the next downturn could be severe and could have significant implications for the global economy. According to him, the downturn could be triggered by a number of factors, including rising interest rates, geopolitical tensions, and a slowdown in economic growth. One of the key drivers of the current debt cycle has been the buildup of debt in the global economy. Dalio argues that debt has been growing faster than income, and this is unsustainable in the long run. He believes that this buildup of debt will eventually lead to a crisis, and we need to be prepared for it. According to him, the next crisis could be worse than the 2008 financial crisis, and we need to take steps to protect ourselves. Dalio believes that one of the most important things we can do to protect ourselves is to diversify our investments. He argues that we need to invest in a range of different assets, including stocks, bonds, and commodities. This will help to spread our risk and reduce the impact of any one asset class on our portfolio. He also recommends that we invest in assets that are likely to perform well during a downturn, such as gold and other precious metals. Another key recommendation from Dalio is to have a plan in place for the coming downturn. He believes that we need to have a clear strategy for how we will navigate the next crisis. This could include having a cash reserve that we can draw on in an emergency, or it could involve having a plan for how we will manage our debt in a downturn. Well, the concept of Ray Dalio's big cycle comes into play that explains the long-term economic and market cycles that he believes shapes the global economy. According to him, these cycles are driven by the accumulation and reduction of debt, and they follow a predictable pattern. The first phase of the big cycle is the debt cycle expansion phase. During this phase, the economy is growing, and debt levels are relatively low. This is a period of innovation, investment, and expansion, as individuals and businesses take advantage of the low interest rates to borrow and invest in new projects. The expansion phase is characterized by rising asset prices, strong economic growth, and low unemployment. Investors are optimistic about the future and are willing to take on risks to achieve higher returns. Companies are also investing heavily in new projects, which helps to create jobs and stimulate the economy. However, as the expansion phase continues, debt levels begin to rise and interest rates start to creep up. This marks the start of the second phase of the big cycle, the debt cycle contraction phase. During the contraction phase, debt levels have reached unsustainable levels and the economy begins to slow down. Interest rates rise, making it more difficult to service debt, and there is a general sense of pessimism in the market. This is a period of deleveraging, defaults, and recession, as individuals and businesses struggle to keep up with their debt payments and many are forced to default. As the contraction phase continues, there is often a period of significant economic hardship. Unemployment rises, asset prices fall, and many businesses are forced to close. However, as debt levels are reduced, the economy begins to recover, leading to the third phase of the big cycle, the debt cycle reflation phase. The reflation phase marks the start of a new cycle, as interest rates are low and there is a lot of liquidity in the market. This creates an environment for growth and investment, and the cycle begins again. During this phase, there is a lot of optimism in the market, and investors are willing to take on risks in order to achieve higher returns. This leads to rising asset prices, strong economic growth, and low unemployment, and the cycle continues until debt levels become unsustainable once again. According to Dalio, the big cycle can be broken down into smaller cycles, each lasting approximately 10 years. These smaller cycles are also characterized by periods of expansion, contraction, and reflation, and they can be used to help investors understand where we are in the big cycle. By understanding the big cycle, investors can make more informed investment decisions and prepare for the challenges and opportunities that lie ahead. For example, during the expansion phase, investors may want to take on more risk to achieve higher returns, while during the contraction phase, they may want to focus on preserving capital and reducing risk. Ray Dalio's Big Cycle is a powerful framework for understanding the long-term economic and market cycles that shape the global economy. It highlights the importance of debt and its role in driving economic growth and contraction, as well as the need for investors to be aware of where we are in the cycle to make informed investment decisions. By understanding the big cycle and its implications, investors can better prepare for the challenges and opportunities that lie ahead. Now, here comes the concept of a debt bubble, which refers to a situation where an economy has taken on too much debt, which becomes difficult to service and can eventually lead to an economic downturn or recession. Several factors have contributed to the rise in global debt. One of the most significant has been the low interest rate environment that has prevailed in many developed countries since the financial crisis. This has made borrowing cheaper and more accessible, increasing debt levels across many sectors of the economy. However, as debt levels rise, so does the risk that these debts become unsustainable. This can lead to a situation where borrowers are unable to service their debts, leading to defaults and a loss of confidence in the economy. This, in turn, can lead to reduced economic activity and a recession. In addition to the risk of default, high levels of debt can also make it more difficult for governments and central banks to respond to economic downturns. For example, if interest rates are already low, it may be difficult for central banks to reduce rates further to stimulate the economy. Similarly, if government debt levels are already high, it may be difficult for governments to implement stimulus measures without exacerbating the debt problem further. The rise in global debt levels in recent years has led to concerns about the sustainability of these debts and the potential for an economic downturn in the near future. Well, the billionaire recommends that we take steps to reduce our debt levels. He argues that too much debt can be a significant risk in a downturn, and we need to be mindful of our borrowing. This can involve paying off debt or refinancing at lower interest rates. So the warning about the coming economic downturn is a reminder that we need to be prepared for what is to come. We are at a turning point in the economic cycle, and the next downturn could be severe. By diversifying our investments, having a plan in place, reducing our debt levels, and being prepared to make tough decisions, we can help protect ourselves and our finances. It is important to take note of Dalio's warning and take action now to prepare for the economic challenges that lie ahead. Well, this concludes everything about today's topic. Let us know your opinions and questions in the comments. And if you enjoyed the video, hit that like button. And for more interesting videos like this, subscribe to our channel. Also, don't forget to subscribe to the channel and press the bell icon. Thanks for watching. We'll see you guys at the next one. Until then, peace.